building edge doesn't start with strategy. Building edge comes with the things that happen before you click the mouse to put in an order.
Welcome to The Sound Trader, a podcast where we explore how real traders navigate the complex and dynamic world of financial markets. I'm your host, Graham, and while we typically focus on how traders use audio and other sensors, today's episode takes us deep into the world of professional prop trading development. In this episode, I'm reconnecting with Michael Barrett, who we last heard from in 2014, episode 1. Michael has since spent over a decade as an active prop trader in Australia, trading US and Australian treasuries and index futures, as well as mentoring and designing the trainee program at his prop firm in Sydney. Through his experience, he's observed hundreds of traders go through the complete journey from trainee to established professional. You'll hear Michael's insights on what separates successful traders from those who don't make it, the importance of screen time and curiosity, how trading edges evolve and disappear over time, and the often overlooked challenges of balancing trading with life responsibilities as traders mature. Michael also shares his perspective on building competitive advantage from the bottom up and how to position yourself against algorithmic competition. So whether you're considering a prop trading career, are currently in a trainee program, or simply looking to understand what it really takes to build a sustainable trading career, Michael's decade-plus experience offers valuable insights into the realities of professional trading. So let's dive in. Our listeners will be very interested to hear what's happened to you since that 2014 podcast, which a lot of people have listened to. You have been my go-to expert on trading all of these years. We kind of went down our different paths in trading. You actually took it seriously and shifted your life to Sydney and commenced your career as a prop trader. And we talked to you in that podcast episode about 1 year into your journey. So my question for you as a bit of an icebreaker is, where's the piles of cash behind you that
spent it all.
We've had
all the things traders do. I did them all.
Well, that's what I'd hope to hear. And just in brief, for those that glazed over the podcast intro, you had a successful career at one prop firm and then you switched over to another firm. You traded actively for a decade at least.
Yep.
You mentored other traders in the prop firm that you've been with for a long time now. And what's the name of the prop firm?
Starbeater.
Are they still online, or is that?
Yeah, that's still happening. I still manage a group of their experienced traders.
Okay. So you shifted into mentoring. You designed their trainee program and would have seen a number of intakes. Would you say you've observed hundreds or thousands of traders through their program?
Not thousands, but high hundreds of trainees, yeah.
So while actively trading, and I'm aware you were primarily spreading treasuries and index futures perhaps between the US and American markets, you were mentoring trainees of this trainee program. If anyone wants to see your trading setup, they might not be aware that that's your head on the price squawk page still.
Yeah, exactly. Yep.
So tell us a little bit about that journey. And, you know, what I'm really curious to hear about, and I've probably nagged you to death about this over the years, what was the life cycle of a successful trader in the context of your prop firm, entering the trainee program and coming out the other side of it?
So in terms of like a life cycle of the typical trainee?
Let's categorize it as a trainee who came out the other end, funded, and making a living out of it at some point, and perhaps the trainees who gave it a crack and petered off. I'm curious about the differences between those two and your observations of them.
I'll start with basically the guys that are able to do the full process, sort of going through, establish themselves as a trainee and coming out the other side as a successful and established trader. I can probably begin, and that kind of parallels with my own story as well, because as you mentioned, I was trading the bonds and the equity indexes for about 10 years. Typically, there's very little in common of who is going to be a successful trainee, who's going to become established as a successful trader. There's not really a set of characteristics that is high probability. Guys can basically come from a lot of different backgrounds, and we've seen that be successful. But the one thing that generally is in common are they are generally younger, so in their 20s, and have very little else going on in their life, with a deep curiosity on, how do I play this trading game? How do I become established? And having the curiosity of working out the game as opposed to being primarily driven by just wanting to bank cash. Obviously, to some degree, everybody comes in motivated by making money, but the guys that have this curiosity is really a big part to it. And being in that spot in your life where you're just young and single, very few other responsibilities, seem to be something that paralleled with guys becoming successful as well. And so because the idea is it's hard to become established, right? And in particular, the guys would come in with a finite supply of savings, which they would be able to try and see through for hopefully 6 months till they can become established, be paying themselves, and you can either get on the right side of that or the wrong side of that, whether or not you actually manage to establish yourself. And then so once you are established, then it's a case of the things that help you get up and running and become established. They still remain important, but other things become more important as well. The longer that guys are around, the more that their life outside of trading also begins to change. They've started this thing as young, single, in their 20s. If they're around for long enough, their relationships become more serious, mainly maybe marriage, maybe family and kids come along as well. And with the group of traders that I'm currently managing, with the more experienced guys, they're not asking questions around trading related and where do I put my stop and how do I review my trades and that kind of thing. The questions with those guys is more and more around how do I manage how the rest of my life interacts with my trading going through time. They're the main kind of conversations that I would be having like today, and that has been the case for quite a while, because it's really difficult. Like, as you know, we traded all sorts of strange hours following opportunity. You got to, but like particularly the guys in the crypto world, it's brutal. There are no weekends, there's no holidays. If something's happening, you more or less have to be kind of close by to be able to jump in. And that's all very easy when nothing else is happening in your life. And when you've got all other responsibilities, that becomes quite difficult. And so I was trading myself until around a year and a half ago, and my twins were born in 2020. And so I was very much in amongst the same situation, asking myself the hard questions of, okay, I've got twins now, I've got a young family, and this is taking a lot of your time and attention, energy, focus. As well as that, I was obviously still managing a group of the established traders. And can I give this everything that it needs to in order to be competitive? And the ultimate answer to that was no, that I wasn't able to do it.
Do you think that that's probably one of the most important filters any aspiring trader should ask before they give it a crack? Because I'm aware there will be many listeners who don't fit that immediate profile of young, free, single, but they have at least saved up disposable cash that they can risk in the markets. Can they still approach the game the same way, knowing that they've got disposable income? Or do you really think it's a hard filter that if you do not have that full-time flexibility and life flexibility, you probably should be looking at another use for your money?
I'd say that there's two answers to the question. Like the simple answer to the question is trading is insanely competitive, And in order to be competitive, you basically have to be doing whatever the benchmark is of the competitive people. And one of the brutal things about that is the guys who are just young, single, hungry, in their 20s, they're the ones that set the benchmark of what's required. And so that can be, doing long hours, sleeping under the desk for days and weeks at a time. But it's a very unreasonable request to ask somebody to do that. However, the guys that are actually doing that and do that successfully, they're not viewing themselves as this big sacrifice at the time. There is nothing they would rather be doing. And so they're the ones that set the benchmark of what's required, in particular to become established. I'm sort of talking about that phase of your life where you're trading and becoming established.
When you say becoming established, would you say you mean they've found their edge in the markets and are able to consistently execute it? Is that your definition of established?
Yeah, well, at least they've found an edge that's currently working and they are consistently executing that at the time now. They may not have gone through the cycle of having an edge come and go because they just hadn't been around for long enough, but they're generally established and they're making enough money to be able to just pay the bills, pay the rent, and be able to keep developing themselves. They're at that kind of stable point where they're not going backwards in terms of savings, and they can see how long their savings are going to last, and they need to, it's the guys that have gotten in front of that. I would say that's the first round of becoming established.
We all hear that 90% of traders fail, for example. Is your observation the same in your trainee program? Like, what percentage of traders would be there months after the trainee program has effectively let them off their leash?
Percentage of traders, it's probably quite difficult to put an exact percentage on it, but it is reasonably low. We don't try and sugarcoat that at all. Like, the understanding is, like, probabilistically speaking, that less people are going to actually have their trading dream get up and running than the ones that do. And there's a lot of different factors that can go into that. With becoming established as a trainee, typically it is that case of you've got cash saved and you're trying to race against the clock to be able to make money to support what you're doing before your cash runs out. And so a lot of the times we did speak around 6 months or so is what's required to have funds ahead of you. Now, you can be a bit lucky or unlucky at the exact time you arrive. If you arrive and market conditions are quite good for that period, it's obviously easier to make money and become established. There's examples of guys that have been rather unlucky in terms of you just come along at very low volatility for a period of months as you're trying to become established. And not that people didn't make it through that, but it certainly is harder. And so it does show how the luck of the timing of when you attempt it can actually make a difference. And so if you contrast that with somebody who is in a different phase of their life, they're already working, so they have some income, and they're treating this as something that they're doing on the side, as an interest and something that they're trying to establish themselves in, but they have a much longer runway. And so they are really reducing that element of luck of, all right, this 6 month period where I'm trying to get this thing started, am I going to get lucky or unlucky that the 6 months have good market conditions or not? They can essentially stretch that out for much, much longer because they're not under that time pressure. And so that's certainly something that you can gain a whole lot more experience over a longer period of time, and that can help.
So with these traders that are finding themselves established at the end, I recall in a previous conversation that we've had that screen time was one of the key factors of who became successful. Do you agree with that still? And can you elaborate on it and what we mean by categorizing screen time? And obviously you can't just turn up, observe the markets and become successful. So what are we talking about there?
Yes, like screen time is a really good proxy for the time that you're actually sitting in front of the market. Obviously, there can be a degree to which you are concentrating or not concentrating, or fully focused and thinking about scenarios of how things might play out and then testing those out. You can, or you can be sitting there passively. But generally speaking, like when people are talking about screen time, they're talking about times when you're actually sitting there completely focused with what's going on. And the more that you are doing that, definitely it certainly does help. The other part to it is as well, I spoke at the beginning about one of the characteristics that helps people become established is that curiosity. And so they are genuinely curious about how do I fit this puzzle together today? How is this going to play out? Could it be this type of scenario? Could it be that type of scenario? And that means when you have that natural curiosity, you're basically always thinking about it. You're not waiting for the end of the shift so you can switch off and go and watch TV or something else. You're always thinking about it when you're in the shower, when you're walking home, thinking about what happened today and how might that lead into tomorrow. And so that curiosity is an important part to it. So it's not just screen time. You don't get money for, okay, I did my 60 hours of screen time this week, or that's not what actually pays. You get paid by putting on trades that make money, and you do that consistently over time. And so that's part of it as well. If a week is extremely low volatility, there's very few opportunities. At the very beginning, you probably do want to sit there and push through that so you get the experience and the feel for what that kind of thing is like. But it really becomes an art of managing your energy in amongst what opportunities and stuff are there as well. If opportunities are great, you really have to take the opportunity while it is there. And if they're not, then you can dial it back a little bit. And you need to do that because, we play this competitive game day after day, the whole year. Even competitive sport has its off seasons. We don't really have those. And so you do have to do that. And obviously it's very easy to take liberties with that and take your foot off the gas a bit, but you're really just being lazy as opposed to properly restoring yourself and replenishing yourself. And so that managing that side to you becomes a skill that's developed as well.
It's currently summer over in the US, and we all know liquidity backs off a bit over this period in the US markets. Are the successful traders, they're still trading?
Well, no, you have to take breaks, and sometimes you're on the other side to it, and you do have to force yourself to take breaks. So some of the most enjoyable parts of being a trader is when you actually get to go and live like a trader or like the movies, the perception in the movies of what it is to be a trader. So like they are some of the really nice parts and the rewards to it. And so when you're trading the bonds, there is this quarterly roll period, which the game very much does change during that quarterly roll period. And so for quite a while, I would have that kind of seasonality throughout my year where 4 times a year when you're getting this 1 week roll period, that I would take a break during that time and, go and do some cool stuff, go and do scuba, go and do skiing, those sorts of things. But opportunity won't necessarily fit in with what your calendar is when, if good opportunity shows up and you've got a chance to make more money in a very small space of time than what you would usually do in a month or even longer, then it's your job to be there and hit those things and make whatever sacrifices are needed in order to hit that particular window.
Now, since you designed at some stage the trainee program, or were heavily involved in developing the trainee program, are you able to give us some insights to the framework that you used to develop traders?
So generally speaking, it's the idea is you want to be having people trade live fairly soon. Like there's obviously an initial period of around 2 weeks where you're going through a number of exercises and drills and things that will gather experience in a broad sense. But generally speaking, like around a couple of weeks in is where we were getting everybody live. And remember the trainee program that I was conducting was all in crypto. And so the great thing about crypto is no sim is required because you can trade such tiny amounts of money that are basically meaningless, but you are participating in the real market as opposed to trading on a simulator, which is obviously not, it's an okay experience of trading, but it's not a perfect representation of how fills happen and that sort of thing. And so you can go trading live very, very shortly after starting as a trainee, but that doesn't necessarily mean that you're taking on the full risk and things like that. Like you can go live and burn your account heaps of times because it's such a tiny amount And so you really can push to gain a lot of experience in there. And so the format, it was always in-house. And so having the people that had successfully gone through the trial period and the initial assessment, which was done online, they would come in and we would have cohorts, and depending on the frequency of it, around sort of 6-ish cohorts per year. And then they would come in groups somewhere between 12 and 18 at a time, everybody in-house trading or coming for the initial period of the exercises, and the drills would be kind of set hours just so you can have everybody in there at once. But then once that period had finished, people were able to kind of set their own schedule, which most people, stuck together and did follow the opportunities that were there, which was quite often a lot of the US session. And so there was plenty of people in the office overnight.
What guidelines would you give traders, if any, on how to make money though? I'm assuming a lot of the traders in the cohorts, you actually would select for traders who may have a blank slate, so they don't have any preconceptions of how markets work. Would you agree with that still?
Yeah, I would agree. There was really not a meaningful difference if somebody had been trading in a retail capacity, trading something on their own for a year or 2 years. There wasn't really a correlation that experience helped them. If I would lean one way or the other, it potentially didn't. Not necessarily for having the experience in itself, but we were teaching people to trade in a particular way because there were certain edges that we did have. One of the edges of being in a prop firm is you are able to put all of the trades from the firm together and then to be able to have cheaper fees. A lot of the crypto exchanges have a fee structure based on how much volume that you do. And so when you can put all of the firm's volume together, you can typically get into the cheapest fee categories. Whereas if you're a retail trader, you can't necessarily do that. And so the simplest way to put that is if you enter how far away is it, how many ticks do you need to make before you're in profit once you take out the fees that you've paid. And so one of the things of getting the people that had a lot of experience prior to that to realize was they could now take trades that other people in the market couldn't. If you're paying, you might get in and a retail guy might need 7 ticks before he's in profit, just as an example. But when you're getting the fees associated with the prop firm, you might only need 3. And so all of a sudden you've got a whole bunch more opportunities that are available to you because you can be in and out before somebody else would even be profitable. And so that's something that we would push very heavily. Here are trades that are accessible to you, but not to other people. That's actually measurable edge, right? To be able to do that. And so it would be having people trade in alignment with that. And as well as that, we had a bunch of connectivity to different exchanges as well, which was very efficient connectivity based on our own infrastructure to be able to have, quick connectivity between different exchanges. And so, whereas if you're sitting at home trading on your own internet connection, you don't necessarily know where your trades are getting routed to in order to reach the final exchange. Whereas we could tell which path our trades were taking to get to which exchange we were trading on. So there's a speed advantage there as well. And so you obviously want to try and play to that speed advantage. And as well as that, we have our own software that the traders were executing on in-house, which obviously helped with speed and just to be able to have a few little extra assistance around some order execution and things like that. So those are the general areas where edge was actually mechanical and measurable. And so we were obviously pushing people to be trading to utilize as much of that as what they could. The guys that had very little experience outside found it easier to trade in those particular manners. Some people that had experience outside and were kind of attached to trading in a particular way or used to trading in a particular way, sometimes did find it harder to change their strategy to incorporate those edges.
Among the cohort, would you see a very divergent set of strategies emerge amongst traders? Or since you provided the firm provided those core fundamental edges, do you think traders tended to use the same strategies and trade around the similar market events?
You would see divergences well down the road, like talking a few years into a trader having been around and been established. You would see divergences in strategies come in at that point. But if we're talking sort of the first couple of years, generally speaking, the guys that were successful were pretty well within the guardrails of what we had set them up with initially, and pursuing the same types of opportunities in amongst volatility that they can take advantage of on an intraday basis. Among the different exchanges that we were trading, it was really the guys well within those guardrails that became established. And then when I say down the road, you would see divergences. People would be around for long enough that they see different strategies come and go as far as effectiveness. Things go in and out of favor. And once you have seen that a few times, you become very less attached to your particular way of trading, because you'll understand that there are a particular set of conditions that supports this strategy being effective, this strategy having edge. And it's very confusing the first time when it goes, because all you know is that all of a sudden I'm making money, I have some edge, I understand what my edge is, but you probably have no idea what it is about the particular set of market conditions that is in existence at the time that supports that edge actually being there. And so those underlying conditions can drop away and you don't realize that's happened, and all you see is that you've stopped making money.
Do you have a specific example that you could elaborate on about an edge coming and going?
It's probably the easiest example that you can give would just be a general one to do with volatility. And so when we're tying that in before, like if you know where your scratch point is, if you get in and you know you need 5 ticks or whatever in order to scratch. Now, if generally speaking, the ranges are a case where that 5 ticks is happening every minute, like the 1 minute bars are giving you more than that 5 ticks, that's very good conditions to be able to trade in, because there's so many opportunities per day or per session where the market will move at least enough to get you that scratch. Whereas if you go into a period where that shrinks and you know that average bar shrinks to below that point, and it means that when before you were getting an opportunity every few minutes, now you might only be getting a few opportunities per hour, and traders won't necessarily feel the difference in that the first time around. It can take a bit of time to be able to understand that. And I'll give another example in terms of breakouts and fading, because it quite often happens in a pretty cyclical nature as well, particularly when it's busy. So generally speaking, the market volatility will kind of contract into a range, and this can be on the daily chart, it's in a range, and people are getting used to the fact that it's in a range. And so the market doesn't go too far when it's in a range. And so traders sit there and they kind of learn that, geez, my breakout trades aren't really having the follow through here at the moment, but the fades are working well. And so you kind of get into this point where fading's the thing to do. And so slowly everyone works out that, okay, fading's the thing to do. And they get into this habit of fading to the point where it snaps. And fading is the inefficient thing to do, because that's the thing that everyone's trapped in on the wrong side of. And then so breakouts go, like breakouts end up working. And so you'll have this period as well where breakouts, and then the traders that are able to kind of flip that around quickly and go, okay, everyone's trying to fade, everyone's standing in too close, breakouts are the thing, and you can make good money doing that. And then the cycle just goes the other way, where all of a sudden people slowly catch on, okay, the breakouts, they're going now, I'm getting run over on all my fades. And so to the point where breakouts go less and less because the people that are on them are taking profit. And so it's kind of that front running each other, trying to take the profit of the breakout that they successfully got on. And this happens in cycles. And obviously you could look at that cycle on its own, and then you can obviously incorporate the cycle of volatility coming and going, and that sort of average bar range that I was speaking about before. And so just with those two dynamics, there's a lot of combinations of how things can play out. And so when you're a new trader and you're hitting breakouts and they're working and you like think, fuck, I finally found something that's working, you just want to milk that. You got the blinders on. You don't even want to have it as part of your possibility in the world that breakouts might stop working. You just want to bank cash because finally you're making some money. And so you'll see people go through that pain of trying to hit the breakouts and not understanding why they're not working. And once you've been through that cycle a few times, you become much more aware of how the conditions facilitate the particular edge that's there at the time. And you become much less attached to any particular edge. You become very, very seeking and very, very focused on how do I execute? What types of trades do I do inside the current conditions? And currently conditions are here. Where do I think they're slowly getting themselves towards, and how do I need to adapt? And so that becomes the main skill.
Since you had an in-house trading desk for a lot of this period, were traders able to observe and discuss this cyclical nature? Would they be ahead of the curve because of that communication between traders on the trading desk?
Definitely. A transition from a trader who trades in the office and has become established and then is going remote is something that needs to be really carefully managed. And typically you want to allow that to take a long time for them to do that, to not just kind of switch overnight that they don't trade in the office and they trade from home now, because it's an extremely different environment. And one of the things is just less input. And like the guys have a Discord where they'll be able to banter with each other on it, and it's helpful a little bit, but it really can't replace being in the office environment. Only one person is generally able to speak on the Discord at a time, and that person might be talking about rubbish that's nothing to do with something helpful. Meanwhile, if you were in the office, that rubbish banter would still be happening, but a guy, one row over from you is having a conversation with another guy that you're kind of half listening into, and that's all helpful. So yeah, the being in the office is a really important thing, and something that's hugely underestimated about people who make the transition from being in the office to trading by themselves at home. Even if they've got the Squawk on, even if they've got the Discord on, you don't realize the degree to which the atmosphere of the room is an input to your decision making until it's not there. And then all of a sudden, like, the market's really busy and it's just dead quiet around you. There's no one making money, no one losing money, or at least what you can hear, because you're sitting at home by yourself. And it can really alter your perception and your ability to decipher what's going on, because you don't have the input of the atmosphere of the room.
Obviously, prop firms have changed a lot in the last, say, 3 to 5 years, with the online prop firms going mental. How can traders replicate this learning environment, do you think, with the online prop firms? Because obviously a community in the BitMEX troll box isn't going to benefit you in the same way as you've talked about on the trading desk.
This is a question that we don't yet fully have an answer to, which we are trying to answer. And that is, how do we do a better job of having people not miss out on what they get from trading in the office environment when they are at home? How do we recreate the trading floor in a digital environment? Something that we've asked ourselves for quite a while, and there's not a perfect solution to it as of yet. But how do you recreate in a digital environment the experience of being on the trading floor? And there's all the kind of obvious answers that are there, but there's no solution to the something that you would half hear two other guys talking about, and they're just talking about it because they're interested, whereas they wouldn't necessarily open their mic and put that into Discord. It's more just a one sentence that's a really impactful, useful thing for you at the time, that's not really noteworthy enough for them to broadcast themselves on the Discord for. That's the important stuff. And so, yeah, we don't have a perfect solution for that. But as best as you can, to be in groups with other people that are trying to do, either the exact same types of trades you're doing or very close to it, and all hunting that thing together. as best you can, that's what you want to be doing.
This ties in actually unexpectedly to the main theme of the Sound Trader podcast, is that there is a perception input to the successful traders that your prop firm has produced, because they're getting communication from their environment that we're suddenly missing in the online prop trading world. You hinted at the subtle perception that traders are getting from their environment. So the small conversations on the trading desk and things that would not necessarily get communicated into a Discord channel or spoken when you're trading alone at home. So it's an interesting tie-in to, I guess, what we do with Price Squawk, where we're trying to include some sort of environmental factor into a trader's input. Are you familiar with some of the core online prop firms?
Yeah.
What are they doing right to try and solve this problem?
So they obviously do have a focus that is on community there as well. There's a lot that they do on social media, and that they are quite active in terms of running workshops and other events which serve the dual function of advertising to be able to, attract new customers coming in, plus also opportunities for their successful traders to speak about what they're doing and share that with other people. And so, they're probably trying as best they can to try to create that community discussion on a very granular level, as opposed to it being on a formal level where you kind of miss some of the finer details.
So I'll segue a bit then, because you mentioned you were trading live up to a year and a half ago. You've seen multiple cohorts of traders come through the prop firm, but that hasn't happened for a little bit of time now. So could you explain what phase the prop firm training program is in right now?
So I was conducting the trainee program until during COVID time. So the only reason that is the time when I stopped it was because that was when my kids were being born, and so that meant that I stepped out of the training at that time. The trainee program was running for at least another 3 or so years, and then the reason that we paused it temporarily was because of market conditions at the time. It was becoming increasingly difficult, and it had been a prolonged period of the crypto winter, as they call it. And during a crypto winter, lower volatility, there's just less chance that somebody who comes in with a finite window of time of, 3, 4, 5, 6 months of worth of cash saved up to be able to become established. And so, if you're going to present this opportunity, you want to make sure that there is a very good chance that the people who come in to take it will be able to utilize that. And at the time, we basically felt as though that there wasn't a high enough probability of that happening. And so this now has got us into the situation where we're now looking to reimagine the way that it does happen. How do we actually operate on a broader scale so that we can do more of this online, as opposed to having small cohorts of trainees in the office? Because that also, we had plenty of trainees that came from outside Australia, and there's the concern of their having to secure visas that allow them to work. And there's a lot of inefficiencies that happen, obviously, to get the benefit of being able to trade in the office and have yourself become established in the office. It's a huge benefit. But, the reflection on how the world has shifted since pre-COVID as well is, how do we be able to conduct this, or at least a lot more of the process, online and still have it be as high quality as what it previously was? That's the questions where we're currently in amongst.
So there is the possibility that you will be taking further cohorts in the future once you've solved that problem.
If there's a good solution to that problem, absolutely. Yep.
Because I imagine a fair few people listening to this will be, well, this is great. I mean, how do I get into such a training program? Because it doesn't seem obvious with the current range of online prop firms that there is an equivalent online prop trading program to what Star Beta was offering. So I'll put in the show notes links so people can keep an eye on what's happening. I've got a few questions here that I'll fit in. They might not all be related, but I want to make sure we address them. So You've had you've had a significantly longer career than most traders that I know of. If you were to start over today as a trader, what would you do differently knowing what you know now?
The key understanding that I would like to go in differently with is an understanding of how building edge comes from the bottom up. Like, building edge doesn't start with strategy. Building edge comes with the things that happen before you click the mouse to put in an order. And so what I mean by that is, when I was speaking about before, we could take trades that plenty of other participants in the market couldn't take because it was too expensive for them to get in and get out as quickly as what we were able to do. That is edge. If you're able to execute faster than other traders, that's edge as well, because you can take an advantage of an opportunity while they can't take advantage, or they're too slow to take an advantage of it. And so you want to be able to, as best you can, build something like that for yourself. And at the very least, you don't necessarily have to have this enormous edge that's a mechanical, measurable edge in your favor, but I would encourage them to do a competitive analysis. Who are your competitors in the market, and what are they likely to be paying as far as their commissions, their costs, and what are their edges that they have that are unique to them that they're trying to take advantage of. And that means that if you are paying the retail rates for trading, you can at least understand, all right, there are people that get these fees that are this much better than mine. How do I trade in a way that doesn't directly compete with what they're trying to do? Or, you don't compete with somebody on speed if they're going to be able to trade, get in and out way quicker than you and have direct connectivity to exchanges and things like that. So a competitor analysis will help you understand, do that before anything to do with developing a strategy. And then once you understand that, then you can start building a strategy that at the very least isn't directly competing with that. You can adjust the time frame with which you trade on, give yourself some other tools that other people aren't having. And Price Squawk's a great example of that. Price Squawk is something that I think is helpful when you're sitting there glued, focused on what's going on. It's a very helpful input. But it's also helpful when you're not completely zoned in and focused. You can keep up with what's going on from listening to what's going on while you're actually giving your mind and your eyes a bit of a break. And so that's I would suggest is a great tool to be able to use in that example. But
thanks for that plug.
You're welcome.
I'll take it.
You're welcome. You're welcome. But that would be the thing that I would do differently. And then when you develop a strategy, you're understanding in amongst an analysis of all the other competitors are around. Here is why I think I can make money using my strategy in amongst all of my competitors. No one ever does that. No one. Everyone just sits down and they're like, all right, here's my technical analysis, and I'm gonna go and start drawing lines and hitting breakouts, and they don't understand what other, everyone knows, banks are in there and banks get cheaper fees and blah, blah, blah. But actually understand what is it that a bank can do that you can't because of the fees that they pay, and try and not compete with them. That would be the first thing, yeah.
Where do you think that discretionary traders should place themselves? I mean, based on some of those bottom-up edges that you talked about, why is the only solution not to go and become a quant or learn to program versus look at the screens in the traditional way and click the mouse?
So I really like this question, because this plays into the heart of how I was around and had the length of career that I did have, and make decent money. This is how I was able to do that in amongst a world that from 2013 to 2023 was becoming increasingly automated, and you were competing more and more with algorithmic trading the whole time. You can see charts of the amount of volume that was done by algos compared to manual traders, and the algo volume is just exploding over that period. And so how was I able to compete? And it goes directly to this. The great thing about trading in an automated system, if you set up and you trade via an algo, is you can run at scale. You can trade, hundreds of markets at a time, understanding the correlation between them all, and have that be executed in an automated fashion. To some degree, having a lot of your risk attended to in an automated way, and you're more or less managing the full package of what that is, and stepping in when there's problems. That is the great thing about automated trading. And a lot of the way that will make money is it makes small money most days and then has a few big down days here and there. And the thing is that when they run that strategy across hundreds of markets, making small amounts of money most days, having a few big losses some days, the correlation of all that is very acceptable as far as their maximum drawdowns that do happen. And the P&L at the end of the month is profitable, despite them having had some big down days. The small profits made accumulated along the course of the month make money. What I was able to do, because I was executing in a discretionary manual way, and I was not trying to do it across a whole different bunch of trades. I was trading the bonds and also the equity indexes, mainly Australia and the US. And a lot of what I was doing was trying to price what do I think should be the fair difference between, say, bonds in the US and bonds in Australia, or equity indexes. I was trying to price that. And if the market was where I believed the fair price differential was, then there's no trade. But if it's too tight or too wide, then there is a trade. That was what I was trying to do. And when big moves happen, or another way of saying that is when algos are trading and they're about to have one of the big losing days, they have one of the big losing days, that normally doesn't come out of nowhere. Normally there's a rubber band getting stretched somewhere that's going for, potentially even a few days prior to it snapping. And then it's that snapping when because they're trading hundreds of things, they can't monitor this one particular correlation or this one particular pair about to snap. And so I'm not monitoring a whole bunch of stuff. I'm just monitoring a few things. And I would hunt the day when they're going to take the loss. And I was able to do that because of this pricing mechanism that I was doing, plus the execution strategies that I would use. And so I essentially ended up doing the opposite, where I would have days where you make really decent money, and then a whole bunch of days where you're around scratch. That's what I was ending up to being able to do. And so you can absolutely do that. You need to understand that part of the strategy of automated traders is likely to be in this area. They make small amounts of money most of the time. They'll take big hits. They don't mind taking the big hits because at the end of the day, or at the end of the month, they make profit. But you can hunt that. You can hunt that. And one of the crude ways you can talk about what do you need to do in trading. Trading is about recognizing when someone else is fucked and going in that direction and pushing them till they spew. That is a big skill of trading, which is not necessarily a nice way of thinking about it, but it is predatory. You can absolutely be predatory, and you better believe that everyone else is in there being predatory. Anyone who is of a competitive mindset is attempting to be predatory. And you just have to try and be a predator more often than you end up being the prey. Everyone gets their chance at both sides of that. But you can definitely do that. You can recognize when there's a probability that someone else is about to take a decent loss. They don't mind taking that loss because overall their strategy still makes money. Get on that train and ride it. That's what you can do.
So if you're not the predator because your pockets aren't deep enough, you could still use your discretion to follow that game and see where the pressure points are.
You don't need deep pockets to be a predator. You just have to realize when somebody else's strategy is vulnerable. I know that they commonly do this. This is how they try and make money. But at the moment, they're stretched, and they've been getting stretched for now multiple days. And you know that because that feeds itself, right? Like if a lot of them are getting stretched in a particular way. At some point, there comes like a line in the sand where they need to unwind that position. That's the strategy. They have to stop out of that trade. And if you're aware, you can be aware of that with a small amount of markets and position yourself for that. And you don't need deep pockets to be a predator in that way, but that's what you're trying to do.
So if you're trading using your discretion, how do you look back at your trading while you're developing your edge and identify something that's working versus something where you coincidentally read the market right? Do you think looking at your historical trades and back testing things, what are your thoughts on that for developing your edge?
So I've been on the record multiple times with the quote as saying back testing is useless. And I stand by it. Like, particularly if you are a manual discretionary trader, there's very little that repeats itself in your decision making that is worth manually backtesting. Now, obviously, it's a very binary statement, and you can benefit from doing some quantitative backtesting. You can, but I will stand by the statement of saying unless you are executing something that is mechanical and not discretionary to a very large degree, then backtesting is useless. There's no way that you can take into account all of the individual intricacies that are falling together on that moment and compile them into a backtest that cancels out all of the different variables that are going on. There's just no way that can be done. And you don't need to, because trading, it can be very tempting to think of trading as a binary event. Generally, it's something people do in life as well. It's much easier to think of things in terms of binary events. They're on or they're off. But it's not so much a skill of finding something that's working and then executing that plan. Because almost always, when you put on a trade, you're some degree of wrong in terms of your interpretation. Very rarely do you go, okay, I think this is going to happen, and you trade it, and that's exactly what goes on. That almost never happens, and there's no skill in that when it does. That's just, anyone can make money when you think something's going to happen and you put that on, and that's what happens. The real skill in terms of being a manual discretionary trader and managing your risk in amongst that is, how do I defend when it's not going well? When my interpretation is being that some degree of wrong, how do I defend? That's the art, because the answer isn't always, okay, just get out immediately. It can be very expensive to stop out sometimes, when there is a high probability that you'll be able to stop out in a less expensive manner at some point later on. Now, when I say that, remember, I wasn't trading a lot outright. I was always hedged to some degree. And so you can play with these hedges a lot to really buy yourself time in order to be able to step out later. But the days when you will feel you do your best trading are often days when you've lost money, but you've turned a disaster into half a disaster. And if you do that, that's you doing your job for that month. And those are the days that can actually make pretty big difference to your monthly P&L. And so it's not this binary event, it's this ongoing, how well do I manage this property of being a discretionary trader where you are always some degree of wrong? How do I best manage that to increase my probability of, reducing losses, of buying myself some time if my timing's not right, etc.
If I wanted to be a very short-term trader and only trade a few hours a day, where does that profile fit in your trainee program? Do you think it's possible to turn up consistently for the opening session and make a living out of the markets as a discretionary trader?
Yes, definitely. I do think that it is so. If you were going to choose one particular open, you would probably choose the US Open, which, depending on where you're trading from, that's a good time or a bad time. But if you wanted to do commit to one thing, that would be probably what I would do. It's depending on the time of year as well. When there is, at the moment, there's a short overlap between Asia and Europe because it's summertime in Europe, and so the time zone difference is only 8 hours instead of 10 hours. And so trading the end of the Asian session and the start of the European session, I always liked at this particular time of year, because you're getting real money flows from Asia and from Europe kind of happening at the same time. So that certainly can be a case as well. But the degree to which you have to be rigid is the degree to which you do limit your opportunity and your perception of opportunity that's outside whatever window you're currently trading with or committing to. There's this temptation there to be really consistent, and I'm just going to do these hours every day and I'm going to commit to doing it. And most of the time that is the answer, but every now and again it's not. The opportunity is somewhere else, and you can be aware that there is something happening somewhere outside of your normal window that has a high enough chance of being a very good opportunity, and you want to be able to take advantage of those as best you can.
Are you specifically tied to, do you mentor traders outside the prop firm, or where can traders find you if they want some help in their journey or transitioning through different phases of their trading life, as you discussed?
So I did mention that I still manage a group of the established traders. Outside of that, I also do performance consulting as well. Some of it is technical questions around trading in particular, but then a lot of it does come down to that, helping people manage how the trading and the rest of their life is interacting. And as I said, that can become a difficult thing to manage, and not just with traders. Like, people can be in a case where they've started something and got some good momentum with it in their 20s that's not trading, that's some other business related thing, and then step through those phases of life where you've got increasing responsibilities. And so the performance consulting kind of lends itself to that as well.
It definitely seems like a natural extension of your time dealing in a extreme performance-based industry, that you can extend that to other fields and have some insights of how to help people along. I'll put links to that in the notes. Maybe we get you back when you've got further along that path of solving the prop desk community problem and hearing what you guys are up to in that front. Well, thank you very much, Michael, for joining me. It's been great, and I look forward to speaking with you in the future.
Yeah, cheers, Graham. Enjoyed it as well. We'll talk soon.
If Michael's insights about building competitive advantages resonated with you, you heard him mention Price Squawk as one example of a tool that can give traders an edge that others don't have. As Michael explained, building edge starts from the bottom up. Before you even develop a strategy, you need to understand what tools and advantages are available to you. The Price Squawk market sonification platform transforms real-time market data into audio signals that can help you stay connected to market movements even when you're not completely focused on your screens. As Michael noted, it's helpful both when you're intensely focused and when you need to give your eyes a break while maintaining market awareness. Whether you're just starting your trading journey or you're an established trader looking for additional input, like the atmosphere Michael described from the trading floor, Price Squawk might be worth exploring as part of your competitive analysis. To learn more about Price Squawk and how it might fit into your trading workflow, visit app.pricesquawk.com/listen. If you enjoyed this episode and Michael's insights into the realities of prop trading, please subscribe to the Sound Trader podcast wherever you get your podcasts. In upcoming episodes, we'll continue exploring how traders at every level are developing their edge in the markets. So until next time, this is Graham, reminding you that successful trading isn't just about finding the right strategy, it's about understanding your competitive landscape and building your edge from the ground up.